Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual accounts prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, or any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation of a particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing the webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. All right, guys, so let's talk about a couple of things in the market first, and then we will introduce Mike officially as our guest for today. And he is going to talk about the new platform that he's been working on with PSW Investments called Trade Exchange. First of all, obviously, not good on the indexes. We did have a little bit of a bounce, but that's already kind of wiping itself out. And I forgot they didn't put up the Thinkorswim screen, but we'll look at that afterwards after Mike's done. Anyway, so we have the NASDAQ pulling back a bit. Let's take a look at the hourly chart so we can get the idea what happened. So we hit 27.5 on the Dow. We hit like
God
30.
Damn it. For Christ's sake.
What?
What? I don't know what that was. Sounds weird.
All right, but you're not on mute. Everybody can hear you.
Yeah, that wasn't me.
Oh, somebody said, God damn it. I don't know who it was. Anyway, NASDAQ fell from 9,000. I mean, look, these are normal lines that you would expect to get rejected from on a move up because they're solid. They should be solid support. So they're going to be resistance on the way up. But the problem is, that this already indicates that the range may be moving lower. See, when your support lines become resistance lines, you know, mild resistance is one thing, but if you start getting major resistance here and we consolidate and start moving lower, then you can say goodbye to that range that was at the top here. And if we look at the longer term chart, so in other words, here's your move above 9,000. But as time goes on, if we start consolidating and moving lower, this just becomes a spike up that's meaningless. In fact, you know, if you move out to weekly or monthly, I mean, that's how much time we spend above 9,000. I know it seems like a lot. You know, when you're looking at a daily chart or even a weekly chart or a daily chart, you say, oh, we've been above 9,000 for a while. You know, it's like been all the way since all year, basically. We've been above 9,000. But honestly, when you look at a monthly chart, it's nothing. It's a spike that you throw out. And that's a very key factor in the 5% rules. You have to, you know, one of the key principles in the 5% rules to say throw out spikes, because spikes will fool you. And here you go. Here's another example of it, right? In 2000, we were going like gangbusters. We had a spike up into March of 2000, and then that was the end of it, and collapse, collapse, collapse. And that's unfortunately very much what this looks like right now. So we'll see. I mean, and again, there's no direct reason that we should collapse. But honestly, since Trump was elected in 2017, we've been pushing a little too hard on the markets. There's been too much Fed meddling and different stuff coming in, and too much enthusiasm for a mediocre business environment. And a lot of this stuff is fluff. And coming back to on the NASDAQ in like the 7,500 range would be nice and healthy. It would be great to consolidate here and then start moving up again once profits start catching up. On the S&P, 2,500 would be a good line. You know, in other words, it's fine. You can say this was kind of legitimate, but then we got overly enthusiastic. We go, what do we have here? Tax cuts, right? Which balloon the deficit. So there's a negative connotation that we're ignoring to what happened. You have tax cuts that balloon the deficit, and you have Fed stimulus that causes massive debt on the Federal Reserve balance sheet, and you have improving corporate profits, but they're improving based on again, back to the deficit, you know, based on us going $1 trillion into debt every year. So the corporations are making more money because the government's giving it to them. That's not a permanent thing. That's not a lasting solution. And eventually, in theory, if we ever decide to pay our bills, you have to go back to those same corporations and say, hey, where's the money we need to pay off these debts that we incurred while we were boosting you guys up? And if that happens, and that's what the revolution is with Bernie Sanders or whatever, if that happens and other people take charge and they say, this is bullshit, we can't sustain this, we need to start being responsible and paying down our debts, and I know what a political crisis that would be, then there you are, right? Then all of a sudden people say, no, let's no more 12% corporate taxes, let's go to 30% and see how that is. What's that going to do? That's going to cut all your corporate profits down by 10, 20%. What's that going to do? That's going to knock the market down by 10 to 20%. And it's not going to come back. And that's what I said in that video we were talking about today. I didn't even do my things yet. Sorry. Hang on. Usually I set all this up, but today I had like 500 things going on. All right. So usually, as I was saying in this video today, wherever that was, I know there was a video. What? Oh, it was in a comment. That's why. Sorry. I'll be organized one day. There is where I had it. Maybe. Nope. Damn it. There. Aha, that video. So I'm not going to play it, but in this video, I was on Bloomberg in November, and I was talking exactly about this. And in November, we were, what did you my charts? Here they are. So in November, monthly, weekly, daily will do it. So in November, around this time, I was saying that we need to start being cautious. This is probably the top of the rally, though we may go up 10% from here. So 3,100 plus 10% is 3,400. And that's exactly what happened. We went up 10% on the end of the China trade war, the theoretical end of the China trade war. But then I warned that we would come right back down, or we'd start selling off and have a correction because we were already at the correct price. In other words, we had already taken the trade war and the end of the trade war into account. We ignored the trade war and the market didn't go down because of the trade war, but the market went up because of the end of the trade war, which is insane, but that's what happened. So now all that was baked in, having a trade war with China, having an agreement with China, all baked in. And by the way, we haven't even really had an agreement with China. We only have an agreement to agree, and the details aren't really there yet. We had this little round one bullshit thing. And how do you think China's going to come back to the table and make concessions now with this virus stuff hitting them so hard? You think they're going to come back and tell Trump they're going to give him $2.5 trillion? No, that's gone. That's not going to happen. I don't care what they promise. They don't have the money now. They got to take care of their own house. So, you know, the market went flying up 10%, just like in 2007 and 2008, when everybody acted like everything was perfect and nothing would ever go wrong. And so what if a few stupid banks in Europe went bust? And then even as it spread over here, oh, Bear Stearns, they weren't a very good bank. They went bust. It's no big deal. And then, you know, other people started going under and whatever. And every time it was like, oh, it's no big deal. We'll shake it off. We'll shake it off. We'll shake it off. And all of a sudden, like JP Morgan's almost bankrupt and Goldman Sachs is almost bankrupt. You can't ignore this stuff. It's all connected. And when China loses an entire quarter of their economy, you know, the whole first quarter is shot in China, that's going to affect everybody in the world. Just because you can't see it doesn't mean it won't be affecting you. Not only that, though, but of course, the virus itself is spreading, and it's going to start hitting other countries the way it's already hit China. And that's not good. I don't want to minimize it, but that's not good. Here's your, so used to be just China. Look at, where is this? That's South, I guess that's South Korea. There's Japan. As you can see, Italy, total mess already. Other places in Europe affected. The Middle East starting to get affected. There have been cases, I just read a thing, they said every single continent except Antarctica now has the virus. So it's now everywhere, basically. And, China had the virus since December, and it took until January 24th for it to start moving up. See where this is here? So this was China here. And these are the global cases. And China already was amassing a huge response to the virus here. We aren't doing anything in the world, and the world is not really doing much at all to contain the virus, because it's more spread out. So it doesn't seem as bad when it's all spread out. You say, oh, Italy, oh, Iran, silly Iran, silly Italy, silly South Korea, silly Japan. It's all one thing, and people act like that's not a big a deal. In China, it was clustered and because of their transit system and everything, everybody got sick really fast all around China. But here, we're just starting to ramp up on the contagion rates, and it won't take much for these things. Any one of these spots can turn into this. But we have a dozen or 24 places on the planet right now that could all potentially do the same thing as this is. And then you'd be talking about 1 million people infected, 500,000 people infected, and tens of thousands of people dying. How is that not a problem? And the other thing people aren't looking at is, where's that, the map? Do I have that somewhere? No, I didn't. Okay, hang on a minute. JOHNS, Hopkins virus chart. There you go. So let's see what we're up to. Oh, this isn't even the one. Well, what's all this? What's this? This is new colors. I imagine that's nice. I like that. I think hopefully they're tracking like how many cured versus how many still infected. Online dashboard tracking the thing, yeah. Ugh, yuck. Let me see if that did change. No, it's still the same dots. I don't know what they got, where they got that other one from. So here's your, oh, that's not pretty. I don't like that at all. 1,200 in South Korea already. That's nasty. 374 in Italy. It was 200 on Monday. 178 Japan, 139 Iran, Singapore, Hong Kong. Look at us. And the whole West Coast is infected now. Okay, that's the West Coast of the United States infected. These things are going to spread and get bigger, and you'll see dots popping up all around here. And then New York so far has escaped, and then you're going to see a dot in New York. And once you see a dot in New York and a dot in Chicago, you already have a dot in LA, then you're in pretty big trouble. I'm down here, I don't care. Ha, no. No, Miami will be next also. Anyhow, Mike, where are you? You're in New York, right?
Oh yeah, I got to stay indoors, man.
Jackie was just at the Good Morning America. She was watching that Harry Styles this morning, and she said nobody in New York's wearing a mask. Nobody gives a crap.
Yeah, nobody cares.
Yeah,
not even on the subway.
What's that?
Not even on the subway.
Not even on the subway, right? She rode the subway. She said she was surprised nobody was wearing a mask.
Yeah, I mean, I'm a subway guy.
I mean, and frankly, the masks don't really help anyway, so it doesn't matter. But it's just more of a point of like saying nobody's really worrying about it, which they probably should be a little bit concerned. My mother, I was saying in the post today that my mother called me this morning. And she said, "Don't worry, Phil. I bought a box of masks." I'm like, "Oh, thanks, Mom. Yeah, I'll be walking around with a mask on. Believe me." I said, Mom, I'm just going to stay home and order food. I'm not going out. If the virus is spreading all over the place, I'll probably, avoid people, not go out and hope my mask is going to protect me. Anyhow, so we got, this is my big concern statistic, really. 30,000 people recovered, 2,700 dead. So in other words, of the outcomes, forget that many infected. This is what they do this to make you feel better. They divide it by the number of cases, which is still an alarming number. That's a very, very alarming number out of that. That's 3%. It's not 2% dead. But that's of people infected, and we're only in the middle of the infection. There's 50,000 people. If 80,000 are affected, 30,000 recovered, there's still 50,000 people who are sick. But of the people who had outcomes, 1/10 of them are dead.
Whoa, that's a lot.
Yeah, that's the thing people don't understand. And what you also don't see is how many people are in the hospital. There's 20,000 something people in hospitals. And that can destroy a healthcare system. It's a huge, huge number. We're not prepared to handle it. So in China, with 1 billion people, they're handling it pretty good. For us, the impact would be much more significant because we don't have that many hospital beds like China has. China even built 2 new hospitals just to handle people who are sick from the virus. Europe can't do that. We can't do that. We can't build hospitals in 2 weeks. We have to get permits. So it's not over. And speaking of it not being over, in fact, you can see that despite, let me see, and I just put up some news. So I put one up because I thought it was kind of funny. Something 400. Stocks are bouncing back. The Dow is up over 400 points. So thank you, Barron's. See how helpful they are. At 11:43, they write an article telling you how everything's fine and that you shouldn't be worried and you're getting a bounce and the tech stocks are leading, gold is down, and blah, 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 blah. And it's just the standard bullshit article by people who have no idea what they're talking about while the market's bouncing, whereas I'm telling people to start shorting. But and already we've almost given up all of it. It's almost all gone now. So if we look at the hourly chart, they were talking about the Dow being up 400 points. So that was 11:30, and now we're already back to here, which is more, and don't forget yesterday's close. So we're back to almost flat to yesterday's close already. So I took that NASDAQ short at 9,000 because that made the most sense. That was the easiest line. We were talking about that in the chat room. What did I say? Control F and Q. And I said, so at 10:30, I said, we hit our goal of 27.4, 9,000 for the week bounces, and 31.70 and 11.85 lined up. And if they fail, we can short the laggard, but I go then Q with tight stops over 9,000. So that's been easy money so far because they came down significantly already. And we got the big win off the NASDAQ yesterday too. So everything's pretty good as far as that goes. And that, the futures is, again, if you're supplementing your hedges in the portfolio, that's when the futures are most useful because you're risking losing a little bit of money if the market goes up, and a little bit of money you're going to risk, obviously using tight stops properly the way we teach you. But if you lose a little bit of money when the thing pops back over the line, you didn't need the hedge, and so you take a little loss and you move along and let your portfolio do the upside work. But on the way down, the hedges, an index hedge like that is going to give you some great protection. But as are also the regular hedges, because we have our SQQQs. So we'll take a look at the portfolios. And again, we got Mike here, so we're not going to do big. So the short-term portfolio gained another 10% today. We were up 10% yesterday. We're up another 10% today. A large portion of that is CSQQQ is now up $16,000 on the $15 calls that we have. They went from $425 to $695. And of course, FXP is starting to pay off. That's our China short. TLT not doing well because the treasuries went way down in price, which makes TLT go up, and this was a short on TLT, but over time I'm sure it'll calm down. Natural gas is about even. These are mostly hedges in the short-term portfolio. So we're up $20,000 on the short-term portfolio. And of course, I expect the long-term portfolio took a hit because this is what the short-term portfolio is protecting, our long-term positions. So our long-term portfolio is now down $30,000. So it's doing exactly, the short-term portfolio is doing exactly what it's supposed to do. It's protecting the long-term portfolio with these hedges. But as you can see, it's not 100% protection. It shouldn't be, because otherwise you're over-hedged. But what we're doing is getting a good hedge so that we keep most of our money, our net money stays about the same as the market goes down, and that means we have more buying power as the stocks get cheaper. So, we don't think this thing's over by a long shot. But of course, also the ultimate protection to your portfolio is cash. It's a $500,000 portfolio. We have $475,000 in cash. So we are very, we have tons and tons and tons of buying power. We're only using $173,000 out of $1 million worth of margin. Most of our position, the reason we have cash, obviously we have a lot of positions, but we sell a lot of short puts, we sell a lot of short calls. It drops a lot of cash into the portfolio, and they're not high margin sales, because obviously only $173,000 in margin, but it allows us to keep a very large reserve of cash on hand just for exactly this situation. But you can't be too tempted to jump in too quickly on what is effectively at the moment a fairly minor correction. And the worst thing is also being a sucker and moving into these bounces. Now, I will now transition. So in times of turmoil like this, wouldn't it be nice to be able to get an alert on your phone? Wouldn't it be nice to be able to get an alert on your phone telling you exactly what I'm telling you now? I mean, it's one thing, obviously it's nice to be subscribed in Phil Stockworld and to actually live talk about what's happening every minute of the day. That's always good too. But obviously even our members can't always be on the, can't always be in the chat room. You have a life, you're going around. I just came back from a trip. And in fact, yesterday I was at a conference. Yesterday and Monday I was at a conference, and I can't be all the time on the phone. And if something happens in the market and you want to know about it, and especially things that are actionable and affect our portfolios, we have these portfolios and we make adjustments to them. So if you're following a portfolio and I say something like I did yesterday about adjusting the SQQ or making a different kind of trade or picking one of our stocks and taking advantage of the dip, you want to hear about that live. You don't want to find out about it 3 hours later, 4 hours later when you come home. And if there's a new idea or a covering idea, you want to know about these things. So there's two reasons that we felt Trade Exchange was very valuable. And Mike will give you more background in a minute. But one of the reasons was exactly what I'm saying. People want to know what's going on in the market. They want to get trade ideas. They don't want to be locked to their screen all day walking around. Well, we made a system that does that. But another thing that's important about it is a lot of people aren't that, they have trouble setting up complicated trades when you have multi-leg option spreads, things like that. And this is a system that allows it, that will do it for you. And Mike's going to now demonstrate how Trade Exchange works. We are going to come back after Mike, hopefully, if I don't break the system, because I did when I was playing with Greg before. If we don't break the system, though, after Mike does the presentation, we are going to finish up and see what the market looks like at probably about 2:30 or 2 o'clock, I imagine. It won't be more than a half hour. And we'll see how that goes. But first, let me just see if anybody has any questions, just in case. Mike, can you see the questions, Mike, when I just pop that up? No. If you can, you'd say yes if you could see them.
I mean, I just dropped them down. So yeah, I mean,
you'll see them.
Yeah, I see the chat and the questions, but I don't see anybody's. Nobody's asked one, correct?
No, I have questions. They might not be questions for you. Maybe that's why.
Yeah.
So hang on. Wayne says, talking about spikes up, ABX has been on a tear with gold. Would you advise taking an opening position on ABX after this run up? He means GOLD is actually the new symbol for them, or wait for a pullback. Well, Barrick Gold, GOLD now, was our stock of the year. We took a position back in November because there was a lot of uncertainty. The same thing I said in that video. There was a lot of uncertainty. I felt the market was due for a correction. I thought gold was a fantastic way to hedge. Also, I think if there wasn't a correction, I think the reason we wouldn't have a correction would be because the central banks are just throwing more and more money on the fire. They're devaluing currency, and ultimately that's going to revalue gold anyway. So, so frankly, we're already in this thing. I don't know if you're in our chat room. If so, what trade will you start when you get back in the stock? So we are back in the stock. It's our stock of the year. We're in it in pretty much every single portfolio. Watch would not miss one. But not in the long-term portfolio. How silly is that? That's funny. I didn't know that, guys. Why don't we have Barrick Gold in our trade of the year? It's certainly in the Money Talk portfolio because that's where I announced the trade of the year. Oh, that's holding up pretty well. We're still up 4.8% in Money Talk. So as you can see, that's already, flown higher. We're up about $5,000 on this trade already. So, and then we certainly got it in, I don't know. I thought we had another portfolio. Is it in the short-term portfolio? No. Anyway, I know it's in another portfolio. I'm not sure which one. Butterfly. Oh, Butterfly took a big hit. Anyway, maybe it's only in Money Talk. But anyway, so that is our trade of the year. So if you're in the chat room, I'm going to be happy to do an adjustment trade because I think we should probably look at if it's possible to still put it into the long-term portfolio. Although, frankly, I think the hemp Boca portfolio trade, if I remember correctly, it does make a lot of money. It's whoops. Oh, not hemp Boca. Sorry, Money Talk. So the Money Talk portfolio trade is 30 times 4 is $12,000, and currently it's net 9 minus 2. It's net $7,000. So it's going to make 5,000 on 7,000. It's not terrible, and considering how low that spread is, that's really not bad. It's a pretty safe spread, but we can do better than that. We'll take a look at some other stuff. 1020 says Trump was pissed the market went down. Brendan says, what are your thoughts on IMAX? I love IMAX down here. IMAX is severely, oh, that's IMAX right there. IMAX is severely impacted by, see, that was bad. It went from here to here. So IMAX is severely impacted by the coronavirus. It's shutting down their biggest growth market, which is China. And it's not going to come back anytime soon. It's probably going to shut down Europe and North America too. I think people, if this thing gets worse next week and the week after, people are not going to go to movies, and it's going to hurt. That whole industry is going to get killed. So can they ride it out is really the question. I mean, they're certainly not going to make much money. They're going to have a terrible year, and it's going to hurt them a lot. But do I want to stick with them and buy more stock on the way down? Yeah, I do. But yeah, I wouldn't look at them for a quick bounce because they've lost an entire quarter in their biggest market, and they're going to lose. Next quarter could be much worse. They could basically be almost shut down globally if people are scared to go out. But the entire world economy will go into a recession if that happens. I mean, they're not going to be. It's not going to be. I just won't go to IMAX. It's going to be. I won't go anywhere. I mean, I'll be honest with you. I'm in Florida. There's no virus here, but I'm sure as hell not going to the AMC theater. I'm sorry. If you're going to get a virus, that's where you're going to get it. Is sitting in a movie theater with 500 other people or whatever. I'll go to the iPic because it's got very spaced out seating, but sitting right on top of a whole bunch of strangers is like not very appealing right now at all, and especially in a tourist area like I'm in, where it could be not good. Then it's so pipe up if you can't see it. Let's see. Oh, that looks like my screen. Oh, come back. So hang on a second. How are we doing, guys? Can anybody see my screen? Somebody say I can see Phil's screen, so I know that you can. La da da. Anybody? Uh-oh. All right, great. Boy, that's a hell of a delay. All right, guys. So where are we? Let's take a look. We're getting a little bit of bouncy action. That's our, hang on, let's make that bigger. So you can see the NQ puts, we started just a little bit under 9,000 and they bounced back while we were yapping away. So probably should stop these out. I guess if they go over 89, we should stop them out. I don't want to overdo it. 89 is still down 100, and that's going to be about $4,000 total on 2 contracts. So unless we get over 89, I'd still rather have them than not have them as far as the shorts go. Those are just the ones that we initiated earlier. As you can see, the Dow shorts already made 7,000 something today. So, you know, it's a good day. And like I said, that's how we supplement that's how we supplement what we have in our portfolio already. Because conceptually, look, the money to our portfolio went down maybe 5%. Butterfly portfolio took a hit, but you can't really pay attention to where the butterfly portfolio is because it really fluctuates on things like this. Future is now portfolio, it's interesting, still up. Dividends are still up, but not as much, I imagine. Dividend portfolio took a big hit. It's the volatility because we sell a lot of puts and calls, and when the volatility spikes up, it hits us. And like we said, the long-term portfolio is is this the long-term portfolio? No, how weird. And the long-term portfolio, dun 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 dun, is being strangely slow. That's odd. That usually does not happen. Oh, there it goes, finally. Wow. So while we were talking, it went down to 7.2%. So the long-term portfolio is down a bit, but the short-term portfolio. So like I said, the short-term portfolio is now up 30%. That's making up $30,000 of basically all the losses in the long-term portfolio being made up by the short-term portfolio. But you want to do a little bit better than just, you know, treading water. So the idea is to use these index shorts, and it only takes a couple. I mean, we had 2 of the NQ shorts. They're up about $5,000 today, and the Dow shorts we started yesterday when it peaked out on the Dow, when we were up here on the Dow or something. I forget where we did it. But anyway, those were up 7,500 by the time they stopped out. So you know, you don't need a lot of a hedge to do it. And honestly, if you come in and always come in when it's crossing below, you don't come in when it's going up, obviously. You don't come into a short on the 9,000 line when it's heading above the 9,000 line. As it's crossing below, you enter the position, and then if it goes back over, you get out and wait for it to cross below again. It's not that complicated. And maybe you'll lose 100 if you try it here and it goes back up. Let's see if we can expand that. There you go. So what really happened? We went over 9,000. You're not entering here because it's over 9,000. You wait for it to come up. It comes down on momentum. You go down here. Now you're going in. It goes down. Now maybe you cash out here because it's a pretty good gain, but maybe you don't. And it comes back up. It goes over. Once it's over, you're getting right out. So even if you wrote it out and didn't stop out, you're still going to only lose a little bit of money here. Goes back up, and you're just waiting patiently for it to come below 9,000 again. Then boom, below 9,000 again. This time it never went back over. It just went down, 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 down. Then it goes up, and it goes back down again. And we're still in the, we're riding it out now to see what happens. But like I just said, this 8,900 line, there's a certain point at which you just make too much money to leave it in play. So as we're coming back over 89, I don't want to still leave this thing open if it's coming back up. And you see how fast it leaped out of my screen? So I'm certainly going to take one off the table. Where the hell did it go? So I'm certainly going to take one off the table now. That was easy. So now I've only got one short. I've got a $2,600 or $2,500 profit from the open on that, and I've got a 4,400 overall. And it backed down a little bit, so I'm not desperate to sell the other one, to buy back the other one. But now we'll see how it finishes out. So that's all pretty simple. It's just augmenting though the hedges you already have. That's how you should look at it. Don't make the futures your only hedge. The idea is to augment the slow moving hedges that are in your portfolio so that you can get a little bit of extra, sort of pad the difference between where you are on the hedges and where you are on your long positions. And the same goes when it reverses. If you have very successful hedges and now the market starts to turn up, instead of cashing out your option hedges, which is a pain in the ass, you can just pick up some longs on the futures to ride out the bounce and see how far the bounce goes, because it's real fast, as I just did. It takes you 2 seconds to get in and out of a futures trade. You don't have to worry about the bid-ask spread. It's pretty much immediately whatever the pointer's at, that's what you can cash out for. So better to use the futures for your quick in and out entries. And even if you're going to say, even if you're covered with a hedge and you're thinking about maybe I should take this hedge off the table now because it made so much money, then you can say, oh, well, you know what I can do? I can just basically go into a long at 27,000 like we did yesterday. And we take a long position, 27,000, we stop out below 27,000, and otherwise we ride it up, and that's going to make the money to offset whatever my SQQ hedge loses. So that's how you want to manage that kind of stuff. Everybody's saying they can see the screen. Okay, no questions though, otherwise, good. I don't know what the delay, there is a delay. I don't know how much the delay is, but there's definitely a delay in this sort of thing. So what else is going on? So like I said, in the short-term portfolio, you have your hedges. They're going to make good money. This made like $5,000 since we looked at it last time, right? So they're going to make good money, but they only make the money or keep the money if the index goes down and stays down. But, you know, we get some pretty dramatic moves off of SQQ when the market's dropping this fast. SQQQ. So it went from 16 to 20. And now, another 10% drop in the Dow will be a 30% gain in SQQ. So that'll take you up to 20, I'm sorry, in the NASDAQ. That'll take you up to 26. So our next target level, if we get another big leg down on the market, our next target is going to be roughly 26 on SQQQ, which is huge. That's going to make us, in fact, that's our cover spot. We did sell 20 of these. It's not reflected here yet. We sold 20 short, 26 calls. So there is somewhat of a cap there on us in the upside on 20 of these. But 60 times $6 is $360,000. I think it's $360,000. That sounds like a lot. Is that right? Well, hang on, calculator. I want to oversell it, but it's going to be 300 times, 300 times 60. What? No. Oh yeah, it's $6. So it's 600 per contract times 60. What is wrong with my keyboard? It's making like lots of extra numbers. 600. $600 per contract times 60 contracts. 36,000. That's what it is. Sorry. All right, so it's $36,000 of hedges in the short-term portfolio against another 10% drop in the long-term portfolio. So that's why then you go to the long-term portfolio and say, does that seem about right to me? Well, so far the market's down about 10%, and we are down about $36,000. So we're actually kind of perfectly hedged. All right, that's exactly what we probably need to hedge off. Now, why are we only losing 7.2%? Well, there's a couple of reasons. First of all, we already have hedges. Almost every single position we have here has a covered call. So we're in good shape there. These are these are already hedged internally positions. The other thing is, though, that we're also using a very small part. We're not actually in with $500,000. We have a limited amount of positions. We have a huge amount of cash. So this portfolio is not subject to wild swings. That's why you want to be very careful not to overhedge. Just because if you have a $500,000 portfolio and $475,000 of it is cash, and your option positions are already hedged with covered calls, you don't need a lot of insurance against that, because you're not going to get a big swing in the market. And especially, and this is why you have to understand your trading, the 2022s are not going to move much, and almost everything we have is 2022, or not well, most things we have. Middleby is not, IMAX is not, coffee futures are not, what is it? Philip Morris is a short-term trade. That's probably getting killed. Yes, it is. TD Bank is not a long-term trade. Speaking of TD, that TradeStation is working with, Trade Exchange is working with. I always do that because Mike used to work for TradeStation, so I get confused. This is 2021, so yeah, I mean, probably 50, I'd say more than 50-50, more like 60% of our things are 2022s. And again, it's just a dip. It's 2 years left in these trades. It's nothing to worry about. If anything, for the most part, notice not many of these are very heavy positions. So if anything, we'd be improving these trades and adding to them, because it's not like this, it's not like the companies did something wrong. You know, Discover Financial didn't do something bad. They just have less charges in the first quarter because people are hunking down in Asia, not going out shopping. Freeport McMoRan, again, copper price is very depressed, but gold prices are doing well, so they're not actually getting hurt that badly. Gilead may have a cure. Look at them, they're skyrocketing, so that's a whole different situation, because they may have a treatment for the coronavirus. General Motors, nobody's buying cars in China, not good for them. IMAX, we said, was a disaster. It is a huge disaster, actually. In fact, that's probably half the loss of our portfolio is this one position. Coffee futures, hanging on okay. People still drink coffee when they're home with the virus. Limited Brands just did that spin-off thing, so they're in good shape. Middleby is, you know, outdoor grilling is not affected yet by the coronavirus. MJ is a marijuana ETF. We're playing that for income, so we don't really care. Philip Morris still getting hurt, but they should be okay. SunPower doing okay. TD, Toll. We just did this review a couple of days ago, so it's not a big deal. Vail not doing good again. Raw materials not in good shape. And Viacom also getting killed. Boy, we got a couple of positions getting killed. Considering that, we're actually doing quite well because we had some profitable things already. But wow, I'm you know, I forgot we had Viacom and we have Viacom, IMAX are the ones that are really hurting us a lot. Those are the big losses in the portfolio. Although and this MJ one has been hurting us for ages, so we don't really count that. So anyway, but lots of opportunities. In fact, that frankly means that you could take this entire long-term portfolio, start it from scratch, $500,000, we've used $30,000 of our cash and $173,000 of our margin. So you can replicate this whole portfolio right now as a brand new user, and it's going to, you'd be all caught up with where we were, because in fact, you've got a better entry price than we had on these positions. And I'm not saying they're not going to get better, which means you would still lose more money if you start now, but we don't mind that. These are value stocks that we think will turn around long term. The most likely scenario right now is that the virus spreads. There will be other countries that have very bad outcomes, other regions. You know, and again, don't forget, China is a country that's kind of unique, but even as unique as they are, certainly they spread all around Asia, the virus now. And everybody travels, everybody goes to airports, everybody's on cruise ships together from all over the world. So this is never going to be a in-border thing. And unfortunately, Trump, who's going to speak tonight at 6 o'clock, so in 4 hours, we're going to hear from Trump, or 3 hours, we're going to hear from Trump on the situation. But he still thinks of it like he's actually going to be bragging. If I'm reading what he's saying correctly in Twitter and stuff, he's going to be bragging that his quick thinking of having a border wall and closing our borders to foreigners and so on and so forth is what saved America from the virus. But we're not saved. He didn't stop tourists from entering the country. He didn't shut down air transportation. I don't know, and I'm not saying he should have, but I'm just saying he didn't do anything. All that happened is the virus began on the other side of the planet, and it takes a while before it gets to it takes a while before it can travel 12,000 miles to start heavily infecting Americans. That's just the way a virus works. When SARS started in America, it took a long time before it reached Asia, but it did. We started the last major virus outbreak, not China. And so, you know, and the worst thing is though that, you know, given Trump the way he acts, is by taking credit for stopping the virus or being great at handling it, he's going to be very slow to admit when it does start getting out of control. And he will lie and he will cover up and he will do what it takes to make himself not seem like he was doing. You know, it's like somebody, there was an article about this in the news just before I started the webinar. It's like when Bush said mission accomplished on that boat in Iraq, and they had the big banner that said mission accomplished behind him, and he gave the speech. I mean, that was like 3 months into the war that's still going on to this day. That was mission accomplished. And that's kind of what Trump is doing tonight. He wants to declare mission accomplished on the virus because he needs a win. He doesn't, what's he going to do? He's got a $2,000 plunge in the market. He should be addressing the nation as a president. He's going to blame it on the virus, which it, you know, certainly is to blame for the most part. But also we had a very overbought market. Like I said, everything that's happening is what I talked about in November when I was on the TV show. The only difference is I didn't know what was going to be the catalyst. I didn't know why gold was going to go up in particular. I just knew that there were so many potential things that could cause gold to skyrocket. I didn't know why the market was going to correct. I just knew that a correction was long overdue, and there would eventually be a catalyst that wakes people up and tells them to start selling their equities. And because, as we have said over and over again in these webinars and in line, when you have a thinly traded rally that is led by a very small number of stocks, when people decide to start selling, they suddenly find out there aren't really any buyers because, you know, Tesla is I don't even know what it is right now, but Tesla is, let's say, for example, a $900 stock. Are they not? No, they can't be 9. They're more like 8. They're an $800 stock. So Tesla is an $800 stock at the moment. Could change in 5 minutes. But Tesla's an $800 stock only because the last person who bought the stock bought it for $800. Okay? So Tesla's got if they're 1,000 and it's a $200 million company, 200 billion, $800 times a million is 800 billion times two. They've got about 200 million shares, I guess. That's about right. So they got about 200 million shares. Let me see if it's what 200 million. That seems like too much. Times 800 a share. No, that's it. Yeah, 160 billion. So they've got 200 million shares of stock. But the price of all 200 million shares is determined by the last person that bought a share at any given time. And that's not price discovery. That's almost a random number that is generated. That's why stocks at the close can go up and down significantly, because it's not like the whole company jumped up and down $10 billion in value on the last 5 trades that were made. It's that a few hundred shares were traded at a certain price, and that repriced all 160 million shares, or all 200. I'm sorry, it's 200 million shares. That number's getting me. It's $160 billion. So Tesla has 200 million shares. Yet at any given moment, the price is determined based on what 100,000 or so shares just traded for. That's why it's very, very easily to manipulate these stocks. Also, Not only that, but Tesla has a very, very thin actual float. In other words, probably 80% of their stock is held by institutionals and insiders. Elon Musk, for example, holds 20% of the stock. So it's held by institutionals and insiders who aren't transacting on a daily basis. They're just sitting on the stock and holding it. The whole market is full of people who've been sitting on the stock and holding it. So you're not getting real price discovery because nobody's actually trying to sell it. Like, you know, you can tell your neighbors you live in $1 million home. And that story sounds fine. If you have people in your neighborhood all comping themselves out at $1 million homes, and everybody in the neighborhood sits around congratulating each other on how much their home is worth, except when your neighbor gets divorced in a similar house to yours, and they try to sell the house fast, and they can't find anyone to buy it for. They end up selling it for $800,000. Suddenly, you don't live in a $1 million home anymore. You live in an $800,000 home. That's what the stock market is like. You think you own Tesla and you think it's worth $900, but when your friends go to try to sell their shares of Tesla, they can't find buyers until they get down below $800. And if anything else happens and the market goes lower, maybe 7, maybe 6. That's what price discovery is. Price is not discovered until people try to sell in bulk. And as I was pointing out this morning, if we could find a Yahoo page here, your Yahoo page, no, your Yahoo page, on the S&P, if you look under historical data, now look what happened. We were drifting along. Look how far this goes. These are, you know, we're to December last year. Nobody's even, you barely have days over 50 million, just a couple here. 68 million, 72 million, 95 million. And generally the night, you know, when you get a big day like that, it's not often an up day. Look at that, 113 million, you drop from 327 to 321. So what do you think is going to happen when 113 million people try to find a buyer? We go down. When 161 million people try to sell and find somebody who's going to give them cash for their stock, you have price discovery, you go lower. 217 million people, price discoveries, lower. 135 million, we're going lower now. As long as there's going to be volume selling like this, the market's going to keep dropping because there simply are not enough buyers willing to pay these prices for stocks. It's a huge illusion. You can fantasize all you want that your stocks are worth X and Y, but the reality is there aren't enough people willing to pay that kind of money for these stocks. And that's what I saw in November, and it makes me a big stick in the mud because I'm a value investor and I do the math and I only care about what stocks are actually worth. I don't care what the price of a stock is. I care about what the value of a stock is, because eventually, over time, value actually matters. It could not matter for ridiculously long amounts of time. I mean, it's freaking February, and in November, I was saying this is what the value of the market is. We're at the top now. I did say, though, in my defense, I said we could go up 10%, and I specifically said we can go up 10% because they're going to declare an end to the trade war in China. I said that here. And I said we could go up 10%, but after that, there will be a correction. So I don't really see any point in doing anything right now. We did start some, because the China trade ended, though, we did start some portfolios, but all those portfolios have taken very conservative positions and just very early stages with a lot of cash on the sidelines. And we're waiting for this correction. It might stop here, but it could easily end up here. And believe me, I'll be thrilled. This is where I want to buy stuff. I don't really want to buy stuff here. This is where I said we're topping out. But I said we're topping out, but we could still go up 10% because they're going to declare an end to the trade war and people are going to think that's fantastic and buy. But that is going to be way too high, and then we're going to correct. We only corrected back to where we were. We really should correct back to 2,900. But that's where I am going to be pretty excited. Back to good old 2850, which is our old must-hold line on the S&P for bullish. It's a line that we predicted years ago is where the S&P would top out. Now, what's changed since our 2850 prediction on the S&P back before Trump was elected was that obviously the corporate tax cuts are changed the system. And we had this conversation recently, Jean-Luc and I and everybody else in the chat room, and we were talking about saying, should we adjust the big chart to reflect it, or are these tax cuts permanent, or will they get reversed, or what's going to happen? And we decided the Fed has enough firepower and there's not going to be an immediate reversal of the corporate tax rate. So we did allow a 10% bump in our baseline predictions. That's our old baseline, more or less our old baseline. This is our new baseline. So the must-hold line is a line below which, and we're on the must-hold line for everybody is below right now. Below the must-hold line, you're in a bearish market, no question about it. So as of this morning, we were in a bearish market. As of right now, the market is generally negative. The Dow is down 135 points right now. We are continuing a bearish market. We are very likely to continue to go down and retest that 2835 level, 10% down on the rest of the indexes. So how can you play them? You can short the future. Any of these lines is a fantastic shorting line on the futures. You can we can do modifications of our SQQ plays, which I'd be very happy to help you with in chat. The NASDAQ is going to be particularly hit by the virus. You've got a shutdown. What could possibly hurt Apple? Finally, we figured out what could hurt Apple. It's something we didn't even think about. A virus in China stops people from going out and spending money. And if that spreads to the rest of the world, then basically getting a new iPhone is not the top of your list when you're scared to go outside. You don't say, "Ooh, I'm staying home. I'm not going to the movies. I'm not going out. I'm not mingling with people, but I'm going to go to the Apple store and get an iPhone." That's not the way it works. People are going to put all that stuff off, and it's going to have a big impact on a lot of things. It's already having an impact on the car industry. Not only that, though, but the chain of electronic supply is being drastically interrupted, and that's going to make it hard for Apple to roll out their new phones, which they were counting on to get a sales boost, things like that. There's going to be a lot of that going around with a lot of companies. But again, like I said, we were saying, how's the NASDAQ going to go down? The NASDAQ can't go down unless Apple corrects, because Apple basically supports the NASDAQ. And what could possibly make Apple correct? They're such a fantastic company. There's almost nothing that can hurt them. But this is what the hell? Oh, AAPL. Like, oh, they went bankrupt. But this is a unique, weird situation, and they're going to go down. And frankly, I'm thrilled because we don't have Apple in any of our portfolios for the first time in a decade, just because they got too expensive. We started our new portfolios in November, and in November, Apple was $260, and I didn't want to buy it. And then it went up, and then I didn't pull the trigger then because I thought $260 was like, it wasn't that it was a bad price, it's just that it wasn't a super attractive price. Then it went flying higher in December into January, and that was too late by then. So at that point, I'm just like, I'm sorry, I don't want it. 320 is too much. I would love to have another chance at 260. I do regret not buying it at 260. Hopefully we'll see 240, 250. I know that's probably freaking you out if you're an Apple person, but no matter how much we like a company, this was our stock of the year 3 years in a row. I'm hard pressed I think it was 13, 14, and 15. This was our stock of the year, 3 consecutive years. And the stock of the year is what I believe is the absolute best stock to buy for the following year, each year. And Apple made that distinction 3 consecutive years in a row. That's how much we love this company. And not the irrational kind of I love them no matter what, but the kind of love that says this is a fantastic stock. It's a juggernaut. It's going to keep going up almost all the time. But right here, for the first time ever, when we cashed out our portfolios in November, we did not initiate our new portfolios with Apple. We decided not to re-up, not to get back into Apple because it started going up too fast and we didn't want to chase it, so we waited. And that's where we are now. And we're waiting for a lot of things. Not everything is going to come down. At some point, the Fed's going to step in. At some point, the virus will look like it's in much better shape in China. And even if it's spreading in other parts of the world, as you see a significant decline in China, it means that there's an end in sight. And then you can start saying, instead of people panicking and saying, oh my God, GM's never going to sell another car or whatever crap is going on right now, you know, here's Ford. Look at that. It's ridiculous. They're not going bankrupt over this. They're just going to have a bad quarter or two. So as soon as there's light at the end of the tunnel, these are going to be the stocks we want to jump into. But we'll talk about more of that next week, hopefully, if the virus is not really breaking out all over the place. If it is, we're still going to be talking about how we're not doing anything because we're too worried about the virus. So let's see. 10:53 a.m., 81,245, refresh. And 2 p.m., up, very few extra cases. Very few additional net cases in this time. Now, that doesn't mean anything, though, because it's possible that they don't get their reports until a certain time in the day. So refreshing intraday doesn't tell you everything. Maybe China only reports at 9 a.m. tomorrow morning. That means that you won't know until 9 o'clock tonight what the new viruses are. Other countries, who knows what their schedules are. So it doesn't mean a lot when you do an intraday refresh, but at least there's not a spike. And this is encouraging. This is nice. Mainland China trailing off, okay? Not a lot of new outbreaks. They have this thing pretty well contained at the moment. Okay? This is the one we're worried about now. Okay? So we went from 1,000, 11, 12, 14, 17, 2, 24, 28, 32. And that's where we left off. So look, we went from, watch what happens. I don't know how well you can see this, but I'll tell you. So 213 is basically 2 weeks ago. 538 outside of China. 595, 685, 780, 100, 896, another 100, 1,200. 1.1, 100, 1.2, 100, 1.4, 200, 1.7, 300, 2K, 300, 2.4K, 400, 2.8K, 400, 3.2K, 400. It's accelerating. The amount of new cases per day is accelerating. That is not good. That trend has to stop before we start getting confidence to jump back in and buy things under these conditions. Do not mess around with this stuff. It's very simple. It's not complicated to see whether things are improving or not, because you can see very simply by the numbers. Right now, we're adding 400 cases a day. That's what I care about. The net addition of cases each day, 400 more cases. In China, pretty much getting under control. It's not like they're not adding cases. 77.2, 77.7 is 500 cases a day. 78.1, 400 cases a day. They're adding as many cases as the rest of the world, only it's not as bad as it was. They're getting better. The world is getting worse. And it won't take much at all for the world to start doing this. And that will be very scary. And there's nothing that we know of right now that tells us not to worry about that situation. Therefore, we should be protecting our portfolios and being careful with what we're doing. All right, so we're going to talk more about hedging and such into the weekend. We're going to look very closely at our positions this week, even though we just did a review last week. It still bears like checking it out. We are not aggressively going after more longs. We are pretty much just safeguarding ourselves, making sure that we don't have any terrific exposures to things that we're worried about, and we will move forward from there. So there's a lot of work to be done in the portfolios this weekend. All right, so great. And then we'll see what our president, our fearless leader, has to say today at 6 o'clock. Oh my God, I even laugh when I say it. Okay, sorry. All right, I'm not gonna make any commentary. I'm just gonna say, look, I'm a little concerned, okay? Anyway, 3 hours from now, we hear from the president. Hopefully he'll be able to reassure everybody and things are gonna be great. The Dow's down 152 at the moment. That's not as bad as it was yesterday. We're still above where our low levels yesterday. So hopefully we can manage to hold it together. But if not, we got to adjust on the fly. And that's why it's good to have a lot of cash in your portfolio right now. So thank you everybody for coming. Please, please do not forget to go to Trade Exchange and sign up those apps and start using it. Please, there's no other way we're going to be able to test it than having smart people like you be our beta testers and tell us, give us feedback and let us know what we can do to fix this thing. For PSW Investments, this is a hundreds of millions of dollars opportunity. We're very excited about it. We have a big piece of this company. And as Mike showed you, there's an all-star list of people joining us and believe me, this is snowballing because as we are getting more and more in the industry, more and more people are talking about us in the brokerage world. People who were big shots at other brokerages are saying, we want to join your team. They're just calling us on the phone and saying, we want to be part of what you guys are doing. This is incredibly exciting. So, just be a part of it, help us out, and we'd really appreciate it. Thanks. All right, thanks everybody for coming. Have a great weekend, or as good as it can be under these conditions. And we'll do it again next week. All right, thank you.